either sellers get realistic or, it just doesn't trade. But, I see it as a time for opportunity. I do. I don't think that things are going to hit a massive rock bottom, but I think that, we're starting to see some opportunities get fleshed out in the marketplace.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures. From multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Welcome to another episode of Alternative Investor Mastermind. Excited to have a guest today, and I did his show a couple months ago, and now he's on ours. So Kevin Bupp from Sunrise, please just welcome to the show.
Yeah, Jack, thanks for having me. Excited to be here, and had a great conversation a few months back, and now looking to do it up on your show.
Awesome. Well, let's start out with. Would love to just hear your story. Tell us how you got into real estate investing and found the focus on storage.
Yeah. No, and our focus is actually I do have investments in storage, but it's mobile home parks and parking as our primary verticals that we focus in at Sunrise. But backing up about 20 years or so, I got introduced to real estate at the age of 19, so fairly young. Was going to school, community college, with no real local or with no real direction as to what I wanted to, I guess, be when I grew up. And I always joke and say that real estate kind of found me. I didn't find it, but I'm so grateful that it did. And it found me through the form of a gentleman named David that ultimately became my mentor. I just happened to meet him through a girl I was dating at the time. And long story short, David was a local real estate investor, small, I guess, in the small town I grew up in Pennsylvania. Owned a bunch of single family rentals and smaller multifamily type properties. And just the immediate thing that I noticed was just a very different lifestyle that he lived than what I had growing up. I grew up with a phenomenal mother and father, middle class family, both working parents, did what they had to get my brother and I through school and, go on one family vacation every summer, so we definitely didn't grow up without. We didn't have a lot of extra, but it was all relative at that time. I didn't seem as though I had any shortages in my life growing up, right? My loving parents and anything else one could ask for. But with that being said, obviously, once I got kind of a viewpoint of maybe what the other part of the world, the other part of the population kind of lives like, maybe the higher echelon, the top 1%ers, it was an eye-opening experience for me. And again, I think that's what really drew me to real estate, to seeing how it had positively impacted his life and his lifestyle. And at that, at that age, at least me, when I was 19 and going on 20, like what was important to me was like making money and buying stupid shit, right? Whatever that meant, right? Whether it be fancy cars or clothes or, just things like that, material items that really aren't all that important today as they were back then. But, when you don't have them, at least those are the silly things you kind of strive for at that age. At least I did. And so with that being said, I got my start by following David around, worked with him for free for basically a year and a half. And just in between going to school and tending bar in the evenings, I would be with him either in his office or out in the field and just literally offered my services to him free of charge, just so that I could learn what it was he was doing and how he did it. He was about 25 years older than I, and so one of the areas I added value was technology. I mean, he was rough on a computer. He didn't know how to put together PowerPoint presentations for his lenders and things like that. And so I was able to offer value not just by being like an admin and kind of doing the menial tasks associated with that, but also by providing value to him with presentations and presenting his deals to his private lenders and things like that. So long story short, fast forward, I replicated his business model, which was single family, smaller multi stuff. I did that in Pennsylvania for a couple of years. Wanted to get out of that climate. Never really enjoyed that climate growing up. Always loved the water, loved the sunshine. Up there, you get about 4 months of sunshine. I need to go somewhere where there was more of it on a consistent basis. Came down to Florida, which is where I'm based today. That was back when I was 22, and basically just really put it on rocket fuel when I moved down to Florida. Much larger population, larger market, a lot more things going on. And so early in my days, in my early 20s, I built up quite a big portfolio of single family, a few hundred single family homes, and also smaller multifamily properties. And then through the years have bought a little bit of everything. I've owned self-storage, I've owned office, I've owned medical office, retail, the list goes on and on. But I back in 2011, really set sights on what it is we've specialized now in for the last decade. I started buying mobile home parks back in 2011. And then ultimately also added another investment vertical to our business about 4 years ago, which is parking. So parking lots and parking garages in very strategic locations. And so that's what we do today. That's our business, Sunrise Capital Investors. Up until about 7 years ago, I did most of it with either my own capital or family and friends. Just some small contingent of private lenders. About 7 years ago, we ventured into the syndication space because what we found is that we had way more deal flow. And also a really robust infrastructure that we had built up over the years. And what we lacked at that point was our money, right? Like, we were doing a deal a year, maybe 2 deals, but it was recycling our own capital, which creates limitations. And so we started raising capital via Reg D 506C about 7 years ago, and have been on a fun run ever since.
That's great. And I must apologize. I knew you guys were mostly mobile home parks as well, but as I was doing my quick research just to see about questions for the episode, I saw you had Tom Dunkel on your show recently. So I think I had storage stuck in my mind.
No, I love storage. I love storage. I've got personal capital in storage. I love the space. We try to stick to our own lane, for what it is we do within our business. Like I said, even we added parking 4 years ago, and it took us about 3 years of researching that industry before we actually decided to dive in and actually make some strategic investments. But we like to stick in our lane with what we're really good at, and mobile home parks has been that for more than a decade now.
Okay, it's great to hear your background, and I had a somewhat similar story, and I've also migrated more into the syndication space, and I found it's a different mindset when talking to investors that are either looking to diversify out of the stock market and into, these private syndications, which really it's only been about 10 years that there was a lot of information available. These used to be country club deals that you really had to know someone because it was not legal to advertise.
That's right.
So it would be great to just kind of talk through the thesis of, say primarily mobile homes, but certainly parking as well, just to, to somebody who's not at all in the real estate business, or is maybe going to move somebody out of the stock market because, the roller coaster is I just think the returns are not, that whole Vanguard thing is maybe good for part of the portfolio. But I think if you're not into alternatives, like most of the multimillionaires and billionaires are, half of their portfolios outside the stock market. So just talk through your experience with mobile homes and why it's a good investment overall.
Yeah, no, that's great. And, it's interesting because we started buying mobile home parks back before it was considered an attractive asset class. There was no institutional capital in the space. I shouldn't say no. There was 3 publicly traded companies back when we started buying mobile home parks. But generally speaking, it was not a, Green Street and all the other, data aggregators didn't talk about it. It didn't have there was no data out in the marketplace that you could go, review as far as how's that asset class doing outside the 3 public companies. It was kind of like if you knew, you knew. And if you didn't, you didn't. But you didn't see institutional groups and life co companies going after that asset class. And so with that, it was interesting because we started we kind of ventured into that space, and it was only as a result of a conversation I had with an ex-banker that ultimately retired and started buying mobile home parks. And the reason why he bought mobile home parks after he retired is he had been a commercial lender for 30 years. This is down here in Florida. And the last 10 years, he was a desk lender for Fannie and had placed a lot of Fannie loans, which was one of the few lenders that actually understood the space, into manufactured housing communities down in Florida. And so a lot of his clients, he got to review their P&Ls and got to have a better understanding of their business and the financial wherewithal of their business and those investments, and was blown away and basically made the commitment to that's going to be my retirement. I'm not just going to sit around and do nothing. I'm going to just put my money in a couple of these parks. And so anyway, I met him, and he really shifted my mindset of standardized multifamily of how we know it, and why mobile home parks were so much better. And that's kind of how the conversation started. And that's how the overall dialogue of why we should buy some mobile home parks and put those in our portfolio, why that started. And I should back up a little bit. 2008, 2011 was a very challenging time. I was down in ground zero in Florida. down here in the Tampa Bay area, and for the most part, lost most of what I had built over the years. Just it was a very different time. The economy, the Florida economy was very different than what it is today. It's much more robust than what it was historically. And long story short, a lot of my assets did not make it through that downturn, and ultimately found myself in a state of rebuilding come 2010, 2011, after a couple of years of really damage control, just trying to dig myself out of that hole. And with that, the part of the rebuilding process was, what's phase two going to look like? What's rebuilding of this empire going to look like? What went wrong last time around? Is there a better way to slice that bread moving forward? And obviously, what I quickly realized is that owning a couple hundred single family rentals, scattered amongst 4 or 5 different counties. While that was great to build my business, and I kind of I did what made sense. That was initial business that someone taught me. I kind of just built that on scale. Along with that came a lot of inefficiencies, a ton of inefficiencies. And I had also bought some smaller multifamily properties before the crash, largest being like a 72 unit. And just reflecting back on the operational side of the business, it was very clear as day, that the multifamily stuff was way more efficient from an operational perspective than the single family. So I knew that moving forward, I was not going to buy multifamily just from the operational side, but also even on top of that, building a portfolio. Back then, we were buying one by one by one. You didn't see portfolios of single family properties come up for sale like you do today. And so the amount of time it took me to acquire that portfolio, I could have bought one multifamily property and basically met the same, overall AUM goals, right? And so with that, it was kind of a rebuilding. Is it multifamily? Now I found out about mobile home parks. Mobile home parks, per the conversation I had, a couple of things that really stuck out to me is, number one, is that they're not building them anymore. There's a massive barrier to entry. They're not bringing new supply into the marketplace. They've kind of got a bad identity just from some bad actors over the years, but municipalities don't want them from an eyesore perspective. Some of them are incredibly nice, but also from a tax basis. They don't generate near the amount of real estate tax as pretty much anything else that you could put in that same place. And so it's just, he kind of preached that to me, that they're not building these things anymore. There's barrier to entry. Find these quality assets in great markets, and know that no one's going to be able to build one down the road from you. So that was really attractive to me, because that doesn't exist in pretty much any other asset class, right? As we see with car washes going up everywhere and multifamily buildings going up everywhere. So that was a big one. Another one was the turnover aspect. Given that the majority of these residents own their own homes, they're sticky. He's like, I've got residents that live in my communities that have been there 30 plus years. And if they sell, they might sell their dog. Like, it stays in the family. It's like a single family subdivision. And when one does go up for sale, they list it, they put it on the market, but they continue paying lot rent until they sell it to somebody else that moves into that home and takes on the responsibility of paying the lot rent. So you don't have that 2 or 3 month downtime that you might have with a traditional multifamily property where you turn a unit. And it's just a very different tenant base overall. And then the overall maintenance is much lower than that of a traditional multifamily. When we don't own those mobile homes, we're not responsible for the roofs, for the plumbing. Basically, the only responsibility that we have as owners of that mobile home community is the infrastructure. So the water lines, the sewer lines, the roads, the common areas, things of that nature. But basically, once the electricity gets to that home, once the plumbing gets to that home, after it gets to that home, the rest of the responsibility falls on the homeowner. And so it's a very low maintenance model, a model for the most part. And again, those are some of the big things that really stuck out to me when it was presented to me. And so it basically I committed after that meeting I had with him, and committed to go buy a park. I was like, I need to go learn about this industry. There wasn't much information out there at all. And that was back in 2010, and bought my first park in 2011 in Atlanta, Georgia, and literally owned it up until, I guess, about a year and a half ago. And so just continued to replicate that model, and it's proved out quite well for us.
Yeah, so you mentioned the lot rent. What percentage of your mobile homes in general do you see are where there's still some park-owned homes versus where the renters own their own mobile home?
It's a great question. Yeah, it's a great question. I will say that in a perfect world, and for the most part, how these were originally constructed and built, most of them were a ownership model to where the residents actually own that home. And over time, things happen, things evolve. And we own a number of parks today. To answer your question more directly, about 85% of our portfolio are tenant-owned homes, and then the remaining 15% are units that we actually own. And we own a number of parks where we own 0 homes. They're all resident-owned homes. And then we have a few other parks where maybe the larger proportionate share is actually park-owned homes, and we might be going through a conversion model where we're selling those homes off over time. For example, we just closed on 2 mobile home parks in the past 2 weeks. This is probably the largest proportionate share of park-owned homes that we've ever purchased. It's 321 lots between these 2 communities, and about 198 of those homes are park-owned homes. And so in that scenario, it's a much more management-intensive model. However, the reason why we built that, or why we purchased those 2 communities, is almost all those homes were 5 years or less old, and so they were fairly new inventory. The last owner basically infilled a bunch of new homes and then sold the community off. So they're very sellable. The homes are very sellable. It's in a phenomenal MSA where the demand for affordable housing is it's ever so present, and so us being able to sell these units off every time they turn instead of keeping them as rentals it's a very clear shot opportunity and business plan. So, but typically we do not like to buy that large of a contingent of park-owned units, because again, it puts you back into the repairs and maintenance business, which takes away from some of the reasons why we got into the space, right? Like, we're trying to lower overall operational involvement in these communities, and when you own homes, that's not the case. You've got to have maintenance guys on staff, to handle turnovers, day-to-day upkeep, things of that nature. So. And on top of that, you got to have a leasing staff. You got to have a legit leasing staff. I mean, if you're turning these like you do an apartment complex, you've got to have staff on hand that can help turn these units and get them released when they come vacant.
Yeah, it makes perfect sense going through the mindset of having lower maintenance, lower operational intensity. But I would imagine, depending on the state, it could also open up a lot of seller financing opportunities, which is another one of my favorite off the beaten path strategies. Just another stream of cash flow.
Yeah. Yeah, no, absolutely. You got there's some nuances with that as far as selling off the homes on owner finance notes. You've got to be a what do they call that, a CMO? Is that correct?
Or have the NMLS. Like there's licensing.
I'm sorry,
on the state.
you got to use the MLO to do it legally, and so. Yeah, I mean, we're there's definitely opportunity there, and there's definitely some third parties that allow you to, if you want to go that route, that will service a node and do all that. But I have found is that this doesn't necessarily apply to these recent parks that we closed on, because again, most of those units are fairly new. I mean, so they haven't been used and abused for 20 years. But if you look at some communities, and a lot of times we don't buy these communities, but you'll find communities that they've got a large contingent of rental units, and they've been, the units might be 80s models homes. They've been rentals for 20, 30 years, and they've been owned by mom and pop operators that haven't put a ton of money back in, whenever these things turn. And, the money that, or the quality of person that you get buying that. And so if you're going to service a note on it, I mean, just expect a high default rate. You're going to probably get those units back on an ongoing basis. And every time you get it back, you're going to have to put them back in decent shape to resell it again. And so I don't think it's that profitable of a model if they're older units. If they're fairly new, it might be a way to go. But no, I get what you're saying. It's a great model.
Gotcha. So, but the newer units, there's a cutoff where Fannie Mae won't lend on a mobile home, and then what is it? I think Warren Buffett's company is one of the largest lenders.
Yeah, 21st Mortgage is 21st Mortgage is Warren Buffett's division. It's 19. I always mix it. It's 1976, I believe. I always want to say 1978, but 1976. Basically, anything before 1976, HUD was not involved. HUD did not give it a stamp of approval, and so you can't legally move on the road. You can't go hire a transporter to actually move a home from one spot to another if it was built before 1976 or before. And so again, HUD got involved in that process more so due to quality control issues and safety issues. I mean, prior to that, there were manufacturers that were just building these things in their their garages out back and and selling them as livable units. So quality control was all over the place back then, and so HUD got involved and put some standards in place.
Gotcha. I appreciate that information. So we've obviously, the interest rate move in the last year has been largest in my professional lifetime, and I was around in the 80s, but certainly not in real estate. But since you were in Florida during during the crash. Like, what's your take on what's happening? And obviously, mobile homes and the single family market are not, they're two different markets, but the single family, to some extent, I would say, would hope supports multi, because if prices stay high and there's not a single family crash, there's way more demand for mobile home parks.
Yeah, no. I mean, I think you can look at it through many different lenses. I mean, I can tell you that it's made it more difficult, being a syndicator and trying to acquire properties. I mean, the seller ask, the delta between, where the actual market value is to where the seller's expectations are. I don't think that delta has closed very much at all. It might have a little bit here over maybe the last 4 or 5 months I've seen, but I mean, there's still a big gap between where sellers need to be or think they need to be or want to be to where the market actually is. But I will say that with all that being said, it's the interest rates have made it more challenging to buy. Lots of things just don't pencil out. I mean, if you're truly basing it on, if you got to get debt on the property today, it's more than likely, if it's a standardized multifamily property or a mobile home park in a good market, you're going to have a really hard time making those economics pencil if you're being honest with yourself, unless you're just absolutely stealing a deal. And, if you found an opportunity that was, highly distressed, which, I think they're starting to actually kind of peek their heads out a little bit in the multifamily space, right? Like there's a lot of debt maturities and interest rate caps that have expired or are expiring. And so like there's pressure there. I haven't seen it as much in the mobile home park space, but with all that being said, it's actually, I feel as though it's created some opportunity for us. And one of the big reasons is there's been a lot of institutional capital that's come into our industry over the last 5 to 6 years. And pretty much all those institutional investors, as well as the publicly traded groups that are in our space, have been pencils down since like October, November of last year. And, they're, while, in the past, they were always competition. Like we were always vowing for the same deals. Like we were trying to buy the same, and our cost of capital has historically been higher. Retail capital is historically higher than that institutional capital. And so there are few and far between times where we actually might, even make it to a final round on an opportunity. Whereas today we're making it there, and we don't got those individuals that, again, that are typically aggressive buyers. They're not buying right now. And so I feel like, the underlying intrinsic value of these assets, if you can find a deal, while it might not pencil with the debt that's in place, but if you can make a case for the underlying intrinsic value of that deal, then we're at a stage where we're still buying assets that we feel make sense from an intrinsic value standpoint, because we know that at some point in time there will be some equilibrium in the debt markets. And right now there's a lot of buyers that are on the sidelines. They're not buying. They either can't buy, they're too scared to buy. But what hasn't truly changed is the underlying intrinsic value. Now, that doesn't mean that what it was selling for, 2 years ago when rates were 3%. That means like, looking at whether it be replacement cost or, if you can make a case for what is equilibrium, what's an equilibrium state in interest rates in the next 2 years? Is it 6%? What's that forward-looking forecast look like? And building a case around that, then we're still buying. And so I think that we're excited. Actually, I've actually, again, in the last 3 months, we've made more offers and made it to final and best and more deals than we had over the past year and a half. And that just tells me something. And the prices, I've seen the prices start coming down. Things that haven't been adjusted, they're not even trading at all. They're going, back out the market a second time. And either sellers get realistic or, it just doesn't trade. But I see it as a time for opportunity. I do. I don't think that things are going to hit a massive rock bottom, but I think that, we're starting to see some opportunities get flushed out in the marketplace.
Yeah. So on the mobile home park, was there that bridge product that I know is getting some of the multifamily in trouble, or most people either community bank or Fannie Mae with a fixed rate?
Yeah. I mean, don't get me wrong. There was some. It wasn't as prominent, and it wasn't as big of a part of the business plan as it was in the multifamily space. More often than not, if there was a value add plan in place, and I could speak for ourselves and a few of the other groups that are our size, what was more common, to get there was a number of regional and national lenders that absolutely love the space. They've got a 5-year product. It might have like a 2-1-0 balloon, maybe even buy down the prepay, but you got kind of 5 years to execute your business plan. And not necessarily be pressured, with a fixed 5-year term in place, and not be pressured to make that business plan happen in a 2-year, 3-year span. And so no risk of the, interest caps or anything like that expiring. And and no risk of a massive debt maturity coming up in a short period of time. And on top of that, what I've always experienced is that, working with local regional banks, when it's a portfolio loan, I mean, there's much more flexibility of working together as a team to figure out a solution if there is a problem that's apparent, right? I mean, they're much more motivated to make something happen, to work with the borrower, again, if there's a challenge coming into play. And so that's what we've always done, and that's historically what I've seen for the most part in the manufactured housing space. I'm not saying that there's not some of those bridge products that are floating around out there that that are common in the multifamily sector.
Gotcha. And then from a tenant perspective, I'd imagine just with the lack of affordability for a single family, it's probably one of the better times to get a high quality tenant that just is priced out of the single family starter homes. Yeah.
That's, I mean, we've definitely, I can speak to, for example, these parks that we recently purchased, the quality of tenant that we've seen going in there. Even if we look at the credit reports over the last 6 months, they've been significantly better than that, of higher quality of that of maybe over the past 2 years. And I can't exactly pinpoint why that is, but I think that your thesis is one that makes a lot of sense to me. A lot of folks priced out of the single family home space that they'd rather, it's kind of their option at that point in time is either rent an apartment, and have neighbors above, below, and to either side of them, no yard, no covered parking for the car, or the benefit that a mobile home gives somebody. Again, speaking to like the community that we just purchased, very nice subdivision type layout. It's got, playground, it's got basketball courts, it's got a clubhouse. You've got your own yard. You got a covered porch on most of the homes. You got your own private two-car parking pad right in front of your house. And so that offers some benefits. And it's typically, if you look at apples to apples, same quality of apartment that might exist in that same market, we're actually the cheaper option. And so I feel like there's way more benefits that outweigh those of going into an apartment complex for those that get priced out of the stick-built homes.
Makes a lot of sense. Well, Kevin, I know you put a ton of content out there, including your podcast. Tell the audience how to get a hold of you.
Yeah, the best way to reach out to me is you can either go to my website, kevinbupp.com. It's pretty much links up to our company, Sunrise Capital Investors, as well as the various podcasts that I produce on a weekly basis. Aside from that, if you want to learn what we've got going on in the in the investment space with Sunrise Capital, you can go over to investwithsunrise.com. There we've got various case studies of deals that we've purchased, various track record of different funds that we've launched over the years, and just a lot of other good education resources that you can divulge in. So with that, through one of those venues, you can track me down.
Awesome. And we'll put all that in the show notes for everyone as well. Kevin, awesome chat today. Thank you so much for coming on the show.
Yeah, thanks for having me, Jack. It's been a lot of fun.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there, all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.